Ladies and gentlemen of the crypto space, we're live on a Monday, July 15th at 11:31 a.m. I don't know about you guys, but woof, woof, I'm back to the ticks. Or some cute catchphrase from The Big Short. Uh, it, the market isn't what people think it is. People uh, occupy this planet and they live their lives and they follow the rules and they never understand the rules in which they follow, nor who created the rules, nor the system that uses the rules to control the people. People understand the rules, understand the system, and you have an edge beyond what people have. So leverage, you have an edge, you know more, you understand more, and therefore you can do more, you can position yourself better. I say that with a little bit of a heavy tone, like, really? But it's unfortunate. It's real. Most people can only process the rules and the blue pill and personal income and personal accounting, and they'll never understand even the corporate accounting rules, and that shit drives me nuts. I don't even want to understand that shit, yet alone private contracts and the nuance of the written word and the power of the written word. And but those are the topics that we discuss. We discuss some far out shit, boys and girls, some shit that's off the reservation. Well, I'm red pill here, ladies and gentlemen. And we clearly discuss what Michael's talking about, and this is going to be a very hot topic in the coming years going forward that most people don't see, and they didn't see between 2020 and 2024, and they won't see going forward until we're already in position. And we were early, and we will continue to be early for the foreseeable future, and it will just get better and better. It's cash flow. Michael's just talking to a TradFi guy how to explain dividends to crypto or crypto dividends to TradFi folks. And we've been just, it's to us, and the conversations that we have, it's like, oh, yeah, that's kind of obvious. It's cash flow from a business. The thing is, people, when I say people, I mean the general public of the planet, don't understand these crypto protocols as businesses. They see shitty websites, they see shitty high yip scams of the 1990s and 2000s, and they don't understand blockchain, which is an overhyped word. They don't understand DeFi, which is an overhyped word. But what have we done over the years is we've defined this space in terms of business, in terms of finance and fintech and traditional financial terminology, because that's exactly what these businesses are. These businesses are banks. These businesses are private creditors, which is your check cashing spot down the block. Fintech companies. That's what these businesses are. I say it with such assertiveness because that's what they are. And I say it. Most don't. Not even most, the majority. Not even the majority, the overwhelming majority don't, to such a degree that this is, I think, going to be a theme for a lot of posts into the future. It's like, oh, because there's a lot of dividend investors. There's a lot of folks that buy those bullshit stocks of corporations at 2.5, 3, 4, 5, 6, 7, 8%. And they're buying them because they understand that the company is giving them a part of their cash flow. And then when they realize, oh, the protocol is giving us a part of the cash flow, they're going to be like, oh shit, that's what the stupid word staking is. Staking. It's a misleading word. It's a confusing word. It's a new word. And it doesn't make much sense to TradFi folks. And I personally don't use it. It's I I own parts of companies. I own parts of companies, and the company pays me dividends pro rata to my ownership percentage. And these companies, guess what, have just a perfect balance sheet with no debt. What? I mean, literally, dividend investors are value investors, so they're looking at balance sheets, they're looking at cash flow, they're looking at OPEX, CAPEX, so on and so forth. So, man, they missed it. Oh, the dividend investors of the equity markets, they just completely missed it. Like, in a scary way. It's like they're looking at balance sheets of S&P 500 or Nasdaq corporations, and they all have debt on them. But you're looking at businesses in these crypto markets that have zero, zero debt, zero human resources, zero DevOps expense, no server infrastructure, nothing, because they're immutably deployed. The best of the protocols that we discuss. The best of the protocols that we discuss. No further work can be done whatsoever, and they will be incredibly successful into the future. And then you just throw in the further work that's being done, and you're like, oh, that's crazy. It gets really weird when you project out about 8 years, and you think about 2028, 2032, on where things are going to be from an iteration standpoint. It's just going to be so freaking weird. It's a weird world where dividend investors and the TradFi market start to monetize this space, and they're like, oh, this makes sense. Oh, this was obvious. And they're going to think they're early, and then they're going to realize, oh, there was a lot of folks that were much earlier than us. And that's us. And that's the conversation we've been having since 2022, when everything started to fall apart. And oh my, the horror was so bad. Meanwhile, it was the best time to understand everything, the best time to own the things that mattered, and it's the best time to set up everything, your business infrastructure going into the future. Because whatever you built between 2022 and 2024 will be here and will exist in 2028, 2032, 2036, into your 50s, 60s, and 70s. You're building your future. That's all I've ever wanted to do, and over the last years, we finally put the puzzle pieces together and started doing it. All right, so ladies and gentlemen, I titled the stream today Q&A with the Captain. So please, if you're on X or on YouTube, ask me some questions. I'll answer whatever you're thinking about. Crypto, business infrastructure, taxes for all I care. That's actually something that I'm quite competent about nowadays. And that's kind of meaningful. Most people don't really like that conversation. They fear that conversation. But when you actually read the rules, it's like, oh, we could talk about that conversation. They have less power than you think. Oh, that's an interesting statement, isn't it? Anywho, while people are thinking about what to talk about, we could look at some charts. We were just doing exit liquidity with Ben and Jedi. Love this move indicator. I look at it on the 6-month chart, and we are not even at the butter zone yet. Had an entire stream the other week at the butter zone, and this is just going to get so damn weird. Uh, this is just mechanically, the mechanics of global finance indicate that when this chart enters this region down here, it gets weird. Now, what does weird mean? Weird means, Bitcoin going up month after month. Well, that's on a 6 month, so let's give you a weekly chart. Let's give you a good weekly chart. Let's give you a non-log chart. Oh goodness, let's reset the scale. Going week, big week. Oh, it was a big week. Oh, another big week. And you're going to have week after week after week of weirdness until Bitcoin reprices to the expanding global currency supply. It's just going to get freaking weird for week after week after week. And it seems from a weekly perspective, it seems such a short time ago. It's only a couple weeks since we were in a bull market. Only a couple weeks. It's funny how that is when you look at your life and all this long time in candle form. It's only a couple weeks. Look at this. Strange, right? Anywho, but that's the nature of capital management. Time is something that's longer than people process, clearly on a daily basis. And what you end up realizing once you've been in this game a long time is I don't give a shit about capital on a daily basis. I care about it on a 4, 8, 12-year basis. So that's where I'm thinking. That's where I always think nowadays. Um, DA advisor got a question. Let's do it. All right, Dan. Good morning. The Cap. Good morning. Are you only familiar with tax issues for U.S. residents and business entities, sir? So, unfortunately, yes, but clearly, yes, that's where I live, and that's what I understand, or those are the rules that I've read. Um, what I've done can be done in any country. Now with ChatGPT, it's just you got to follow the rabbit hole. It's by definition a rabbit hole. You have to find the documentation, you find the statute, you find the from a U.S. perspective, it's literally the IRS rules, the IRC code. You can find local, not city, but you want state or state statute. And the U.S., that's UTC, and in Florida, they haven't really adopted the UFIPA yet, but it's UTC code or um, uh, UFIPA Act. It's not really a law, but it's an act that states are adopting. But UTC that Florida implements is basically the same sentiment as the UFIPA. And frankly, when all is said and done, uh, it's all expressed actually at the federal level. I've got such weird, weird quotes from federal law, IRS rules that are like, oh, so that's why the founding fathers did what they did, and that's why they built this thing as a federalist system, where the states kind of have just as much power as the federal government, or things are delegated from the Fed to the states. It gets really, really weird. But it all starts with the rabbit hole. Read the rules. You got to find the rules. Read the rules. You got to first find the rules. To understand the rules, that's what we have AI for nowadays. That'll help you understand the rules. And then time, because with time, our brains rewire. Even in our old age, we have plasticity, and our brains learn things and grow, and what was not understood becomes understood. So time and documents and AI, and you can understand anything. What else are we going to do with our time? Especially pertaining to the most important thing in our lives, our capacity for financial well-being, which is a precursor to freedom. Not physical freedom, but financial freedom. And financial freedom gives you psychological freedom. It's the capacity to make choices. If you are financially constrained, you're restricted with your capacity to make choices. Therefore, you experience emotional distress. So this is one of the most important things we do in our lives. Um, where's the best place to open a company for someone like me, for example, in your mind? So you see, that gets more complicated because if you're living in a particular country and you're opening a company in another country, there's rules. Rules related, one, to the other country, rules related to your country, and that international cross-border relationship, uh, that increases complexity. The odds are it's probably best to stay within one's country and just follow one set of rules from whatever reporting requirements you may find in the rules, and from a simplicity standpoint, because from a psychological standpoint, simplicity is everything. Um, Everything we do in our lives, we need to simplify because complex shit is unmanageable and is an emotional burden. Simplify. Um, Find the rules. They call it the IRS in the United States. And in the United States, they make IRC code. And that's like just high level expressions of IRS rules and basically the full federal text, which is law documents. But fortunately, there's a fair amount of documentation that helps us understand this IRC code more contextually. So find as many documents as you can, and process it both by yourself, and use tools as best you can. See, at this point, everything has changed with AI because you could at least ask questions, even if the response isn't skilled in a profession. You can assess if the response is logical and rational, and that is meaningful because that is the foundation for a productive conversation. So you can't argue semantics. So that's why rationality is so meaningful. Uh, Semantics and the meaning of words is the root of law. It's the root of common law. It's root of anything that makes sense in our realities. So that's something that AI is great at, is at least assessing the meaning of words, the relationship of words, and arguments. And fortunately, that's literally what law is. It's arguments. So AI is really, in its current form, great at legal documents and explaining things and crafting arguments. This is what it is. Important to know I myself want to be in Israel, yet don't mind where the company will be. So that is kind of what I mentioned. Uh, if you're international from a quote company perspective, you're dealing with rules outside of Israel, and that's hella complicated. And then you also have to deal with local domestic rules. So you probably want to inspect both, at least rule out that you can't do what you want to do domestically first. Um, Starts with the rules. Got to find the rules. Lake Meadows, peace, Noah. Can you explain the move index in layman's? We're here for the knowledge. So move tells an entire story of the financial system dating back to 2002. Give you the 6-month perspective, and I have the time weighted average price up here. You also see the 10 SMA. Both are meaningful, but so basically those are lines on a chart. And this going up indicates a lot of volatility in collateral. Think in terms of Aave if you put Bitcoin on Aave. And if your Bitcoin's going up and down the price, a lot, like given current pricing, let's say it's going up and down $5,000 twice a day for 6 months. Probably not going to want to borrow much money. That's volatility. Let's say Bitcoin is $50,000 for 1 year and it doesn't change in price. Low volatility. That's this chart going down. Low volatility, you're probably going to crank your Aave up to 1.5 or whatever the hell you're comfortable with. High volatility, you're probably going to be like 2, 3, 4. You don't know what the hell's going to happen in the market. Maybe something's going to crash. You better account for that with a good collateral buffer. So high volatility, the world isn't borrowing much. Low volatility, the world is borrowing. And when you apply that story from an Aave understanding to the world, when this chart's going down, the world is expanding collateral. Well, it's expanding the amount of currency it prints using collateral. What most don't understand is that the vast majority of dollars are printed by people and companies at international nation states, not the United States. The United States and this U.S. debt that they've made is small in the scale of the amount of dollars that have been printed outside of the United States. The entire national debt is probably 10% of total dollar supply, and it's a simplification because the national debt has a deflationary impulse first because it's removing those dollars so people buy the collateral, and then the collateral gets into circulation, expanding global currency supply. Anyway, that's a digression. Simply put, if you look at M0, the amount of dollars that the United States have printed is a whopping $5.72 trillion. Meanwhile, global currency supply is north of $270 trillion. So where do the dollars come from? The U.S. didn't print them. The U.S. printed $5.7 trillion. That's it. Everything else is still a dollar. It's the dollar that we use every day. You first have to understand the global financial system. You first have to accept you don't understand what a dollar is. Because a dollar, when you pay a credit card using a bank deposit, you have $1,000 in your checking account and you pay your $1,000 credit card bill. You didn't pay with dollars. You paid with IOU dollars. But the bank didn't care and the credit card company didn't care because that's the system in which we exist. Those are dollars, and those are 99% of dollars in existence. So the U.S. has printed a small part of the global dollar supply. It's not, I don't defend the complexity of the system and how much people hate the system, but it's not, system at least isn't what they think it is. The narratives on social media are completely wrong, flat out wrong. Vast majority of dollars are not even remotely close to printed by this country or in this country. They're printed outside of the United States. Back to move. So, when this chart is collapsing, the world is printing dollars. When this chart is exploding, dollars are getting destroyed. So think in terms of creation and destruction. Post 2008, between federal policies, federal agencies, federal facilities, whatever the hell you want to talk about, the Treasury Department, in combination with the United States Federal Reserve, was focused on the facilitation of the deepest, most liquid market in the world. So what did they do? I like this time frame because it shows 2020 in a single shooting star candle. Every time you get to a certain threshold in volatility of U.S. government debt, they crush it. Crush, 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 crush. 2020 broke it. They crushed it. Everything they did in 2020 was to crush volatility in U.S. government debt. And then something broke. And it started to explode up until all of 22. So that clearly is what took out crypto in 22. And 22 just so happened to be basically when this time-weighted average price on a volatility indicator was broken to the upside. So the volatility in government debt blew up. And they have been pushing it down ever since. So it's been 2 years of an explosion and finally getting control over it. And that's where we are. This is the banana zone. This is the butter zone. This one, collateral volatility collapses to such a degree that the world is like, game on, let's do it. Let's borrow money. That's when the global Aave health factor hits 10. Then everyone levers the fuck up. That's when it gets weird. That's when you start to get capital expansion, maybe emerging market investment, because that shit's at a discount right now, dollar strong. That's when the crypto space does what everyone knows it does. And that's that. That's what the move indicator tells us. So charts are a matter of directionality and momentum. They did what they did to finally change the directionality, because this is all intervention. Otherwise, everything cascades and it just keeps on going. So they changed the structure of the system to finally get collateral volatility under control in H1 2023, first half of last year. And it has been a decreasing volatility environment ever since. And this is probably a forward-looking on DTCC functionality and centralization, which is a story unto itself, but you centralize trading of U.S. government debt, and you're able to control the volatility, slow things down, speed things up, find counterparties, match bids to asks, and lower volatility. It's probably a forward-looking indicator because, as we were talking about on exit liquidity, it's probably not fully set up, if at all. But the market's like, oh, this thing's coming. You better chill out for a little bit. So they're just holding and waiting, which is reducing volatility. Trends continue until capitulation. This will continue down until something frickin' breaks, which it did in 2023 with the banks. And that was probably that's probably accounts for this candle to the upside. And then FDIC stepped in, and the big banks consolidated, started gobbling up banks, and it looks like the market's like, oh, they're just going to buy it all. So we're in the end game. We've crossed the Rubicon of what the government will do to suppress collateral volatility. It's all about collateral volatility, and then geopolitics is really about dollar supply. And does the world have access to dollars? So what the U.S. likes to do is to not intervene in currency. So what they like to do is suppress collateral volatility. If they suppress the collateral volatility rather than affecting currency composition and FX markets, it forces the world to buy U.S. government debt to get their dollars. So they buy the debt, and they're able to print their own dollars. And then that's where we're heading yet again. And that's the way the system works. At 74, the world is going to print the dollars they need to refinance, to do whatever they have to do in order to maintain normal business operations, pay interest on dollar-denominated debt, so on and so forth. They just borrow it. But, we all understand that mechanism. We all love to say it's unsustainable, but it's coming. And that has a very obvious effect on crypto markets. And that's mechanical. That's not even opinion. That's the way these systems work mechanically. Hope that helps. DA advisor, another question. At what point does it start making sense to lock V curve directly and not use wrappers? From what amount of curve can this even make sense? Every investment on the planet reduces to APR. So if you buy a house that's producing 8% in rental income, 8% APR, it's the same as 8% APR in something else. It's the same as 8% in something else. 8% is 8% is 8%. XYZ. How much does it cost? How much is it paying? And how likely is it to continue to pay? So the thing is, real world investments don't tend to produce 10, 20, 30, 40%. But these crypto markets, in their nascent state, you have very interesting businesses of an FX, credit, and derivatives nature that are producing 20, 30, 40, 50% returns, APR on principal, making them very interesting. So the two parts to your question. First, I've always locked VE curve. I historically, in the beginning, I was figuring things out, but suffice it to say, now that's it, just VE curve. Great, derivatives. I love derivatives. Derivatives bolster and strengthen the base layer. I am what's called a base layer maximalist, and that is what I want to own, and that's okay. There's plenty of derivatives, plenty of curve derivatives, and I would say, in my opinion, for myself, I have no need to entertain any of the derivatives. If we go over to here, and you'll notice I am making, bum, 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 if it loads, patience, 36% APR. Tell that to some guy investing in real estate. Oy, oy, oy. So I make 36% on the money, and that's just curve. There's plenty of other businesses in the crypto markets to consider. Plenty of other APRs, maybe just a cash and carry from just a money market like Aave, or just a leverage credit facility or leverage money market like Curve Products, Llama Lend. And then that's why it's complicated. But these types of percentage rates change everything with regard to balance sheet composition, your portfolio composition, and in my opinion, you don't need much beyond this, because if you're compounding at 36% APR, heading into a bull market with move heading into 70 and 60, it's going to be weird between now and 2029. That is a lot of capital to compound, and that is a lot of APR. And it's the eighth wonder of the world, compounding. And at that APR, it kind of changes everything. Most of that conversation about compounding is the eighth wonder, is that whatever bank interest rate they were talking about in TradFi over the last decades, at the highs, what, 10, 15%? And they're like, oh my God, this changes everything. Just put your money in a bank and save, and you're good. And we got this at 36%, going into move at 70 to 60, and the principal appreciation. So what I expect to play out is your principal goes apeshit, crypto goes apeshit. So if your principal goes 10x on the money, that means this gets reduced 10x, so that'd be 3% on principal. But then again, technically, it's still 36% on basis versus spot, just to add complexity to the conversation. But proportionally, if Curve's making about 900,000, 6, 7, 800, $900,000 a week in revenue, let's say that goes to 10 million, 20, 30, 40, 50 million a week because there's that much of an increase in business activity and transaction fees and CRV-USD debt interest payments, then this goes to 360%, 500% APR. And then it gets diluted because at 500% APR, people are buying Curve hand over fist. And the best expression is that this interest rate is proportional to business activity. Makes sense. Dividend. Business makes revenue. Revenue gets distributed as the TradFi dividend concept. And we get all of it. It's that's the difference between these businesses and TradFi. And our APR is inversely proportional to Curve price. So if Curve goes up in price, these APRs come down. And proportional to business activity, inversely proportional to asset price. You can always keep your calculations relative to basis, which is a very interesting perspective also. So for instance, if you're making 30% on your money and you have $1 million, you're making $300,000 a year, and let's say in 25, you're making $1 million a year because business is booming. And then in 26 and 27, oh, the horror, your $1 million a year crashes to $600,000 a year. You see where I'm going with that? Higher lows and higher highs can end up charting your business revenue over the years. Why? Because currency supply in the world has to expand. Therefore, the amount of cash flow these businesses, especially FX, credit, and derivatives, are going to expand as well with higher lows and higher highs. So, anywho, that was not necessarily the clearest train of thought, but I hope there's some interesting tidbits in what I said that are useful. My man. Black Lotus Security, buy land, get land, patent, draft, and declare your independence, live a peaceful micronation, live a decentralized life. It's an interesting thought. They're not going to let you do that in a lot of places. For instance, all the land in the United States is owned by the United States, so you can't declare independence without a military. That gets complicated, but it's a good thought. I see what you're saying. Sergio, present. Tab C, hey, what's up, y'all? Stay private and peaceful, neutral in politics and others. Yeah, I'm so neutral in politics. I don't have patience for all this social media bullshit of people that are angry over one thing or another. It's just, everyone, listen, mind your own business, everyone. It's as simple as that. Continental dollar. Well, that didn't work. There you go. This is something I come back to a lot. Founding fathers of the United States, and their first currency in 1776, and the core principle was mind your business. So I always find that quite interesting, and I always try and think about what were they thinking. Was it? It's not disinterest in other people's business. It's mind your business. Take care of your shit, and that I like to think in terms of if everyone takes care of their own shit collectively, it's a good country. And things start to get fucked up when people are minding other people's business. This is a lot of religious overtones, like don't covet thy neighbor's goods and stuff, and greed and envy and shit like that. So everything's kind of the same thing. All religions are the goddamn same thing. all of this, all politics, it's all the same thing because we're all just humans. It's all the same thing. So stay neutral. Stay neutral in politics and everything else, and mind your own fucking business, and everyone's going to have a good life. That's why finance is a very interesting thing, because it's numbers, and everyone just manage your own balance sheet. Be smart, be rational, don't be greedy, be humble, mind your business, and I think that make a better world. Instead, everyone out there goes around minding other people's business. Everyone has an opinion on social media. Fortunate for me, I don't give a shit about other people's opinion. I care about my opinion. I care about myself and my family and my life. And I hope for the best for other people to make such similar decisions. Everyone should mind their own shit. Stop worrying about other people's business. Hope that helps. Uther. Hi, Noah. Could you share your approach rule to an efficient vote market strategy? I find it challenging to find out which gaze has the best future APR. So you want to get paid the most you can. So it depends on your. Well, bear in mind, vote market's a pain in the neck because you have to vote. You can vote up to once every 10 days. And Ethereum mainnet could be expensive when things get more volatile. So, in my opinion, you kind of want something that has been around and you want to just let it sit. I've changed my vote once in 2024. How about that one? So look at these numbers, 37%, 31%, and it's paying 9 grand. So 2 grand, I'm sorry. 681's a little low. Frax is paying 5,800. No, it's ZUN. Interesting. Not bad. So there's a fair amount there at 29%. So 29% plus whatever Curve's putting out from CRV USD, that's a lot of goddamn percent. Jesus, that's a tremendous percent. So you got to be calm, cool, collected, and stop changing your votes. Find something that's long lasting. So for all of 2023, I literally was voting for Spell. Good old Abracadabra. Had good financing, but unfortunately they've been under the gun. And they haven't been able to keep up because their currency is depreciating. Therefore, they have less purchasing power. And it's hurting their capacity to finance their liquidity depth. And that's unfortunate. We'll see what happens, but this is not a game for opinion or sentiment. This is a game for calculations and numbers. So I changed my vote from them most recently over to Warden. Has a T, TBTC. They've been renting votes for quite some time as well, all throughout 2023. But for smaller positions, I cannot vote for any of these. The 6, I can't really vote for anything unless it's like 10, 15, 20 grand versus worth of rentals because of the number of curve I have. But these are just great revenue. You got 10,000 curve, you could easily get 31% of your money. Because 10% doesn't dilute this much. But if you come in, for instance, here's an example. There's 1.89 million, no, 1.089 million. To come with a million votes curve, you can't get paid 31% of the money because your 50% of the V curve votes means the most you can get is 50% of this, right? So you're blowing it out with the amount of votes you have. So the most you can get is 1350, and that's if no one else votes. So you got to be cognizant of the amount of votes you have, and are you blowing these numbers out of their functional ranges? So if you come in here with a million, the total would be 4.3 mil. So 1 mil of 4.3 mil is less than 25%. So you'd be getting less than 25% of this at most. So you're talking about 1,000 and change at most. So you're not getting 29% on a million curve, which is what, $290,000, you're not getting 100 grand a year, which would be 2 grand a week, let's say. So the most you can make is 1,000, but 29% on a million curve right about now is 2 grand a week. You're not getting 2 grand a week because you've blown it out with regard to the total amount of votes and the total amount of rental capital that has been applied. Hope that helps. So that's kind of the way it works from a vote market perspective. Pretty much the same thing with Warden. Um, things get depreciated, but there's a fair amount of rentals here too. These boys will just keep renting, particularly because Paladin is Warden, so they know the vote rental game all too well. That's interesting that Cleaver threw a couple of bucks and they got a fixed 20%. So 652,000. Huh. That's a lot. So 652, you get a 20% at fixed rate. So no matter how much, 652,000 VE curve votes could be applied here, and no matter what, you will still get 20.57%, considering what they're incentivizing with. What are they paying? They're paying in convex? No, convex reward. Yeah, they're paying in CVX. So of course Cleaver has convex. Cleaver is just is the largest or the second largest convex owner. They dominate. So it's interesting to see that they're renting. Here's the kicker: everyone's going to rent. They're, and it's just going to be the way things go going forward. Everyone needs to rent. You need to rent liquidity. You need healthy markets, and for healthy markets, you need to finance this shit. Fixed rate. So 779,000 opened up, which is cool because this is what I rent. I rent WFT. I'll get $1,200 at the end of the week. So revenues are down. I've had very good months over the years, very good weeks over the years, and this is slow season, and that's okay. When you make less money, you spend less money. When you make more money, you spend more money. Hope that helps, Luther. Killis, good morning. Finally, the notification worked today. Lately, I haven't been getting them and keep missing your lives. I apologize for the notification system not working properly. Damn it. It's always good to have you. It's been a heck of a ride these last couple of years, Killis. Blue Lotus Society, spot on. Growth potential projections is a true art firm. It's going to get so weird, growth projections. What can I show you over here? Macro, nothing fun in macro other than move. This is just pure hopium right here. This is the exciting stuff. This is just, this like, boom, right there, trajectory into the butter zone, and that's where we'll be next year, all of 2025, right in the butter zone. It's just going to get weird. What else do I got up today? Oh, tapioca is up at 381. That is a crazy number. Got a nice clip down here at 130. That was wild. I think I did sell it at 270. Half of it. And I kept my I don't trade, but that whatever. I didn't expect, no one expected an LBP to go like this. This is an absolutely insane chart. I don't even know where to draw this ceiling, but the fact is this is a decent series of higher lows. And I guess this resistance line is right about here. So it kind of broke out yet again. We need a confirmations, but you need longer time frame. You go something like this. This is maybe a decent perspective. Daily chart. That is actually a pretty decent perspective. Check this out. And we push it up just a little bit. There's your daily close ceiling. That's interesting. Well, this can be a breakout from a daily perspective. That actually, by definition, a close on the daily at current price or anything above $3.60 is by definition a daily breakout. Very interesting. Very exciting. South Africa bond 17%. So now Z. What are the odds they could continue paying that kind of rate? Z, X, Y, and Z. How much does it cost? How much is it paying? How likely is it to continue to pay? So the thing is, you have risk evaluation. So for me, smart contracts that are immutable and are tried, tested, and mother approved have a much more interesting Z, certainly as compared to South African bonds, and probably more meaningful than most nation state debt. Uh, and plus 17% isn't enough. I think we could do much better than 17%. And considering global currency supply, along with consumer price inflation, is 12 plus percent in the United States, you need to account for greater than 12%. So anything up into 12% is just keeping up with the shit. So basically, South African bonds, 70%. If that was dollar denominated, you're getting a whopping 5% return on your capital on a yearly basis. I don't think that's meaningful. So I think fintech, progressive fintech, and the crypto space is much more interesting. So that's just that's not going to be everyone's sentiment. It's going to be few sentiment. It's going to be my sentiment. That's just because I understand what the crypto space is offering from a fintech business standpoint. Hope that helps. Brian, happy Monday, Cap. Hope you had a great weekend. Yeah, I feel much better this week. If folks remember last week, I was, I didn't say it, but I was SAF, sick as fuck. It was bad. Big head congestion, so I'm pretty surprised I was able to get out any coherent thoughts. Anywho, today's a better week. Arrow, good morning. Good morning, my friend. 0x. Hey, Cap, have you noticed that currency is spelled wrong on that coin? Yeah, I think they had a misprint. But there's a story to that, but they're sloppy and they messed it up. You know, so someone that didn't have the best English education was doing the the proof, as they call it, for coinage, and they messed it up. Anywho, I find financial history quite fascinating, and this coin gives me a great peace of mind and center of gravity for how I think about a lot of things. And isn't this the cure for everything? Mind your business. It means your opinion is not needed, nor warranted, nor wanted, nor relevant to anything unless it's your business. If you have an opinion about other things, it's not the way to be. It's not the way to live. Mind your business. Anyhow, throw some comments from X and YouTube, please. If you have any further thoughts on your mind, more than happy to answer anything. Last couple of questions, and we'll wrap it up for today. Arrow, looks like RAM could be a good buy. And Lock here, if you had no position here, would you allocate? Let's do it. Okay, so you have to understand how to reprogram your brain. It's not about price appreciation, and that is the misconception. What's pertinent is if this goes between 20 cents, let's say, 2 cents, and 10 cents cyclically for the next 4 years, is that bad or good? Well, if it's cranking out 80% on the money, that's pretty interesting and pretty good because that's perfectly consistent with XYZ. So the biggest takeaway from this chart is that it cannot be inspected from a traditional appreciation perspective, certainly not a capital gains perspective. So yeah, this is interesting. The 1, 2, 3, 4, or 5, a big one, and the start of 6. It looks like there's a decent support. And that's why is that supported? Because look at the volume. So that amount of volume is paying an interest rate. So APR is proportional to business activity and inversely proportional to price point. So if business activity is picking up and price points decreasing, APR is going apeshit vertical. So that's inherent floor for curve, inherent floor for everything. Coin price down, you could buy more. So the APR is higher because you're getting a pro rata share of business revenue. So Yeah, that looks pretty interesting. In hindsight, if this thing goes back to 20 cents and then back to 2 cents, man, that 2 cent, 1.8 cent entry was good back then. I think I got it right about there, about 1.8 cents. Cool. Okay. I don't know. I like it. I like this tech. I don't buy things for the appreciation. I buy things for the APR. And if anything, we go over here. That is an interesting story that we've seen happen. Not fees, revenue, volume. We go over to volume on Avalanche. Not Avalanche. Oh my God. Did I really just say that? We go to volume on Arbitrum. Ramsey's blew Uniswap out of the water by multiples. So, from a fundamental perspective, that's insane. This is the first time in 4 years that Uniswap has been dethroned by multiples. So, something weird is going on. Something is going on structurally in the system that is significant. And frankly, the 3.3 bifurcated incentive regime is there. It's there to be inspected. There's only a couple of real innovations in these crypto markets. And clearly, VE started everything with Curve, and we've learned that voter escrow requires a full-on federation to work from a health and sustainability standpoint. And even then, it's complicated. But Curve is entrenched. It's Curve price down, APR up, business volume up, APR up, and it's found bottom to some degree or another. And it looks like voter VE33 is an iteration on that, Andre's work, and it took years. It took 2+ years for this stuff to finally start to show what it's capable of. And this data is quite interesting to say the least. And it's notable that Arbitrum's volume's up 70% week over week. That's insane. So these are going to be some interesting numbers. I look forward to inspecting this from a 2028, 2029 perspective because I am not legally allowed to sell these types of investments according to my business rules. Velodrome also flipped Uniswap by a bit on optimism, but nothing like what has occurred on Arbitrum. That's insane. Uniswap's still out of the lead on base as compared to Airdrome. Where are we on some of the more exotic chains like Linnea? Haven't looked at this in a bit. Linnea is down 10% of the week. Nice volume, 25 mil volume on micro chain, little Linnea. Still flip-flopping back and forth, Linex and Nile. Very nice, interesting activity. Interesting chain. Mantle. Let's see what the hell is 24% week over week. That's, oof, goodness gracious. But that's interesting. Cleopatra taking a second place position. Man, that's just been a 75, 80%, 85% loss in principal with little to no revenue whatsoever to show from it. At least, Linnea and Nile were and have been and will continue to be, from what I can tell, meaningful revenue producers, especially like Ramsey's. That's just a constant producer. Produces on a weekly. But Cleopatra's just, oh my God, considering the principal appreciation, the amount of revenue it's been producing has been not interesting whatsoever. At least you have the icky LPs to vote for on Linnea. Something seems to be off with adding that kind of infrastructure to Mantle, unfortunately, is what it is. Anyway, this is just crazy. That's crazy. That's crazy. Looks like Ram could be a good buy and lock here. I nailed that for you, my friend. Killis, amen. Love the perspective. If only we all did that. Mind your business, right? Just take care of your family. Take care of your kids. Take care of yourself. If you don't take care of yourself, you're no good to your family. Very simple. And everything else is just doesn't mean much. It's just the truth. Luther, you're very welcome. Only good if you bought at the lows. Yes, well, that equation is very simple. X, Y, Z. You want to buy something that's paying you Z, hopefully likely into the future, and you want to buy it as cheap as possible. That's it. If you didn't buy it as cheap as possible, you didn't buy the optimally. So this is why you need to sniff out distress when nobody's talking about it, when it's dead, it's over, and then you know then you buy. But it's like, oh, then you figure out when to sell. No, it has to be a different equation, and that's the equation we talk about: X, Y, and Z. X, Y, and Z, simply the case, but X, Y, and Z when? As cheap as possible. And that is uh, a prudent financial methodology, strict prudent judgment, and it's proper mentality for a fiduciary. Amun's in the house. Hey, dude. Price doesn't matter. All that matters is the income you're getting. Last round, my vote APR has been 460. Insane. Insane price. You're absolutely right. And that's exactly what I've been explaining. Price is completely irrelevant. And as a price point comes down, you're able to buy more. You're able to buy more, which allows you to have a higher APR. Volume, business activity, APR goes up. Business APR is proportional to business activity and inversely proportional to price point. X, Y, and Z. How much does it cost? How much is it paying? And how likely is it to continue paying into the future? If Arbitrum volume on the network goes up 10x, man, it's going to be interesting cash flow. And I'm very grateful to have exposure to the leading exchange on Arbitrum because I would love 10x on revenue. Not going to lie, going to love a 10x on revenue. And I'm more interested in Arbitrum as compared to Optimism. I'm more interested in Arbitrum as compared to Base. But as an investor, I have my bases covered. I got exposure to Optimism, a little bit of exposure to Linnea, disappointing exposure to Mantle, no exposure to Base, but that's okay because I could not acquire something that's just isolated to Base. I'm not okay with that, especially at the price point. I would need it cheaper. I would need something like an aerodrome. I don't even know if I would at this price because investment season is over, in my opinion. I would need it much cheaper. It was down at 40 cents. No, I don't know. I would want like these guys are gold. You're able to buy a significant percent, a nice solid position at sub 10 cents. Give me 8 cents, and that's still really good for a lot of people because people bought it 2 3 cents. 8 cents, 9, maybe 10 cents. I'm not going to get it, and I don't care because I don't want to. I don't want to invest anymore. I have more than enough. What is it going to give you? It's going to give you the same. It's going to give you an APR. An APR is an APR is an APR. You don't just need exposure to base. You need exposure to the whole system. So you're not getting anything more just because you have exposure to base as compared to other stuff. An APR is an APR is an APR. Have a diversified portfolio of APR. Does it not worry you that curve yield is being diluted by token emissions? No, because yield is proportional to business activity. And in the future, business activity is going to go multiples. I mean, that's not even like a speculative statement. There is currently $162 billion worth of stable coins in these crypto markets when there's a trillion, when there's 5 trillion, when there's 10 trillion. So business activity is proportional to the amount of dollars in the system. Then you get the endogenous dollars. So this is in good part. This is actually predominantly exogenous dollars, USDC and USDT. But endogenous dollars are like CRVUSD, MIM, DAI, and that's when it really gets weird. That's when you get the 5 trill print on this chart, and then I don't give a crap about dilution. What I care about is simplification. And for me, I don't have to worry about a liquid staked wrapper. Oh, is there an opportunity to liquidate it? And that happens to be incompatible with my business rules. I get significant, my business rules strongly express doctrine, substance over form, and economic substance. So by adhering to a locked position as a locked position in perpetuity, I clearly establish economic substance, and I'm required to mark that position at a $0 fair market value because that's substance over form. I am accurately expressing the reality of the position in my accounting books. I can't sell it, and it's deterministically, immutably locked. Therefore, it has a $0 fair market value. It's non-transferable. So that adheres to the substance over form doctrine, and that these are very critical things that allow me to comply with domestic United States business rules at the IRC and IRS level, also including stuff like the UFIPA and the UTC as well as Florida statute. So turns out the crypto market post 2020 changed everything according to the rules of the system. There has never been something that is provably out of a trustee's control. So that's a critical part of a trust, whether there's unfettered control by the trustee. So, with regard to like an originating source of capital, and that's traditionally called a grantor. So if a grantor wanted to be trustee, there's potentially a conflict of interest there. Even if there isn't potentially, there's arguably a conflict of interest there. But when you could lock something and the trustee provably does not have control over that capital, changes everything with regard to what is and is not arguable. That's quite fascinating from a substance over form perspective, and from a conflict of interest perspective, and from a sham trust analysis perspective. It's provable. It's quantitatively provable that even the trustee cannot just do whatever he wants. There's no unfettered control. It's quite fascinating. Truly said investment season is over. I'm done with investment season. That's fine. I spent the last 2 years accumulating income, buying a whole bunch of shit. The whole portfolio is completely different from 2022. Folks are about to get frantic as the market starts to go ballistic. And I told everyone here in 2022, when the next cycle happens, it's going to be sit back and watch the fireworks and sit back and watch the fun. What don't I own that I need to own? I have exposure to all the major networks. I have all the FX market exposure I need, all the credit market exposure I need. All the protocols I own have either supported directly or indirectly by countless derivative protocols in a federated fashion by the Curve ecosystem. I have all the exposure. What more do I need? If anything, if there's any more investments that are done, I'll be reaching, and I'll be like, ooh, what could I buy? I have money. What could I buy? And that is no way to manage capital. That is not fiduciarily prudent. You want to, as a fiduciary, you want to really need something to invest, and you want to protect capital. So it's like, unless it's like obvious, rather not invest. And that's the appropriate mindset to have. Hope that helps. 99 trillion US. I mean, at least 10x, 50x, a trillion, 5 trillion. I mean, that all seems small compared to the global economic system at 270 plus trillion. And we're not even talking about like, that whole Bitcoin gonna encroach on gold's market cap. I don't give a fuck about that shit. I care about dollars, which is very antithetical to the crypto narrative and Bitcoin narrative, but dollars matter because not from a whole argument of opinion. Just literally had a conversation about mind your own business, and I'm like, I don't really care about the opinion that people have out there about dollars. What I care about dollars the most is them as they're used in accounting, which is basically a unit, the number one, and it happens to be how everything is accounted on the planet. And that matters. So when you account and break down and analyze these crypto markets in terms of dollars, $162 billion, that's a very small number. It's microscopic. And it'll get bigger. And when it gets bigger, I don't give a shit about curve dilution. I care about business activity, how much CRVUSD debt's outstanding, and how much interest is paying on that endogenous dollar. Because CRVUSD is an endogenous dollar. Mechanically, that is what it is. Not even an opinion, just mechanically what it is. It seems like Curve is a bet on a multi-stablecoin world. I see a future where USD-based stablecoins are sustainably funneled into one canonical stablecoin with massive network effect and governance control. Well, if anything, the world has taught us that there's always competition. There's always the best, and the best doesn't always win. Betamax was hot, but VHS did much better. Cassette tapes did much better, to such a degree that Betamax was nothing. Laserdisc was big tech, didn't really go anywhere. Inferior tech did much better. So the world is filled with a history of not the best tech doing better than the best tech. And, I mean, look, Cobol still runs our nuclear infrastructure. They're trying to fix that. That's another story. Point being, the world is filled with competition, and I think that the plenty of different types of stablecoins and different credit facilities and different FX markets and different derivatives products will all do very well. Because we are 4 years into this market, and if folks really think that we're going to start invalidating entire products 4 years in, the market isn't even a market. It's microscopic. Nobody knows their ass from their elbow. We're speculating to high heavens about where things are going to be. And in the end, in 4, 8, 12 years' time, we're going to have this rich, robust market filled with 10,000 new protocols of the likes of the curves and the auras and the balancers and the cleavers and the Aladdin stuff and the tapiocas. And everyone and their mother in traditional finance is going to think they're going to do it better. And then we could start to have a more meaningful conversation about what's actually going to survive and what's going to do well. And I will always go back to the original stuff, the stuff that has lindiness, that's time-tested, mother-approved, that's entrenched and base layer. And we were there for the base layer. And that's the deal from the 2032 perspective. You were here to start to watch the birth of an emerging market, of emerging markets, when there was $162 billion in this emerging market. And in 2032, when it's 10 trillion, you're like, yeah, we were there when it first started. And then there'll be the few folks who will be able to tell the story of 2019 when Uniswap V1, Uniswap Beta had, pretty sure I remember when there was about a half a mil on Uniswap. And then I remember a mil, and then I remember it started getting crazy. It's like 10 mil. I was like, what the hell's going on? Remember when Curve launched, it was the first mil, and it was like, what? There's $1 billion on Curve. It was crazy. Everyone was going absolutely nuts back in 2020 when there was $1 million of trades and volume and activity and deposits. It's like, what? And there'll be the few of us that remember those absolutely insane days. Will you describe the Curve Federation in a bit more detail? I saw the Federation stream, but interested to know a little bit more. Yeah, couple minutes. I'm going to wrap it up. Let's do this. Curve voter escrow is a bifurcated incentive system where you are incentivized to lock because of governance and control, and you are paid basically to lock by people that want to rent your capacity to vote where dilution is targeted. So it's an incentive system, meaning the only way it's sustainable is where other protocols are paying me to lock tokens. I already have my investment, but the point is other protocols are paying, and that incentivizes people to purchase Curve from the open market. And they're often paying by dilution themselves. So, but that's taking the burden of financing off of Curve, and they are disrupting circulating supply. So the first was convex that really changed the chart for Curve. You go over to Curve. Yeah, that's clearly not an interesting perspective. Let's go over to the daily. Let's go over to the weekly. We'll drive ourselves nuts. And the initial rundown is irrelevant also. Not really, actually. So this is basically convex time. This is the weekly. So about a month or two into 2020, and convex came online. So this is Curve unto itself, a hyperinflationary decay. But then convex started disrupting circulating supply. And then all the way through 2021, you had a myriad of protocols come online. And this is really an expression of the Curve Federation. And this is just an expression, in my opinion, ever since highs all the way down to lows, of the market just completely mispricing it. And this is to get the grand recovery, and maybe a decent takeaway is something very similar to the VE33s currently, except slower, which is actually very common in finance, where you have one chart that seems to be really slow and another chart that seems to be hyperdrive of that chart. And that's kind of what VE33s are right about now. So if this is not arrow, but if you look at like a Ramsey's, it's the cyclicality between a range. So hyperinflationary decay, appreciation, because as the price point comes down, the APR goes up, so you get the cyclicality, boom, 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 boom. So that could be something that plays out here. It's like appreciation, push down, appreciation, push down. The long time push down, appreciation is like $10 and then it crashes to 3. And it's like $12 and it crashes to 6. And you get these very sharp periods of appreciation and then the pullback. And you get that kind of cyclicality. This isn't the type of shit, as a Moon said about RAM, the price point's irrelevant. What matters is the cash flow and as cheap as you can get it. So if 30% APR costs $5, all right, and then it cycles up to 13 and it crashes to 8. That's just the way this type of chart is going to play out. This is a new type of chart, and this isn't a capital gains type of chart, because that is a juvenile and simplistic way to look at charts, because you are not running a business based on capital gains. I mean, sure, you're a hedge fund, but I'm not running a business based on that inspection of a chart. And these are the types of charts that I want to see to run the business the way I want to run it. I want to see Ramsey's go from 2 cents to 20 cents for the next decade, cyclically, with on average 100% APR. That's the thing. It goes to 400%, and that's why it's off bottom. Because who in their right mind is not going to buy 400% APR? At some point, the APR gets so high based on business activity that it's a no-brainer to buy it. That's the way it works. Dilution, you'll drive yourself nuts over dilution. Business activity in the market going up 10, 100x, 160 bill in stables to 5 trill. Dilution doesn't mean much at all. Any idea about XCVX and how is it leveraged without liquidation? No, I'm not looking into it right now. Don't make me expend any more brain power. I appreciate it though. It could be a concept similar to face value and hold to maturity, stuff like that. I don't know it off the top of my head. Or it could be like Alchemix and how it's self-paying debt type of instrument. But there's plenty of room for that kind of innovation. So maybe it's along those lines, just speculatively speaking off the top of my head. Yeah, I was in the house. Hello. Good morning. Finally catching a live stream. We'll leave some questions. Got to go, but we'll catch later. Okay. I'll do these questions, and then I gotta go. Thank you, Captain. I'm just starting to learn about DeFi, so I have some hope of some light at the end of the tunnel. I appreciate your streams. Yeah, if anything, we think about things a little bit different over here, which means we have different expectations. There is absolutely no expectation to turn $100 into $1 million around these parts. We're old school dividend investors, and I have much more reasonable expectations. And for better or for worse, attract that won't attract hundreds of thousands and a million people watching live because like BitBoy used to do. It was just there's no degeneracy here. If anything, this is a rational capital management discussion on how to do things differently. Last couple of questions, we'll wrap it up. Mike Howell recently said that the three most important factors of global liquidity are bond vol, Fed, PBOC liquidity injections. I'm not sure how to think about liquidity injections from Fed and PBOC. Well, you could skip over the PBOC and Fed liquidity injections because that'll be expressed in bond volatility. If they are not adequately uh, preventing liquidation or preventing capital destruction, that will affect China's requirement or China's need for dollars and Japan's need for dollars and anyone's need for dollars. If capital is getting destroyed, shit needs to get sold either for liquidation purposes or sold in order for capital to prevent liquidation. You sell your bonds if you need dollars to make payments on debt. So you see all that in the move indicator. Move indicator is like this one incredible indicator that tells you so much about the system. Move is exploding. I'll leave this chart up as we're talking. Things are blowing apart. If move's exploding, things are blowing up. And look at this, 2002 to current in this tiny little chart. Boop. But it tells you so much about the system, especially at a 6-month perspective. And there's your little butter zone down there. I hope that helps you. I'm just simplify it. Move indicator is really all you need to tell you, are they actually achieving what they're looking to achieve? And clearly with such a high time frame, you got a whole lot of bullshit that'll happen over a month period. You can literally have something blow up and bam, it gets suppressed like 2020 because the market completely collapsed in 2020. They swept it under a rug in about 1 to 3 months, making the 6-month candle basically just a wick. Also curious, what do you think about curve recent locks? More than 100 mil, if I recall correctly. I guess to improve Z. Any further insights? Yeah. I have a couple of opinions regarding Mitch's liquidations. He exited liquidity, and that's fine. He created the protocol. How do you get rid of all those tokens? You get rid of all those tokens, one, either by just playing delta neutral and just doing what you're doing, and he was getting all that capital and just financing all these incentives everywhere because he was managing his liquidity, these delta neutral positions. So that was cool as long as it worked until something blew up and boom. Was able to get rid of his excess supply. One of the biggest issues with investing is vested interest. He had a large vested interest. There's other protocols out there with much worse vested interest, but he had a large concentration of capital. And what's healthiest for the protocol is to get rid of it. You can't just give it away. You got to make it look reasonable. So he got liquidated. He's not complaining or worrying. He has a nice ownership of the protocol, nice revenue, plenty of cash flow. He's been around since Bitcoin old days, and frankly, I probably would have played it exactly as he played it. How else do you get rid of? You can't sell them because then you destroy what you created. So you get liquidated. In which case, it's organic. So everything played out lovely. And I think we'll look back in 4, 8, 12 years and be like, that's as good as it could have been considering the amount of tokens that he was able to accumulate and a whole lot of decentralization aside from the protocols like Convex, which is kind of a decentralization of a centralized control because plenty of people own VLCDX. And I think the overall tapestry of what the Curve Federation is quite appealing in its current form. Another one, does TW Tap need a federation? No. Has similar overtones to what V33 was going for, but it's a whole nother ballgame. Tapioca is a whole nother level. All emissions, all incentives are options emissions, so all incentives have a capacity to build protocol and liquidity and also have a capacity to finance TW Tap holders. It's pure business revenue. So frankly, I think we're in uncharted territory with Tapioca, and most broadly speaking, I see this crypto space as a three-tier evolution. Voter escrow started everything. Curve started everything. I mean, frankly, synthetics started a lot back in 2020, late 2019 with their emissions contracts. That's too early. So voter escrow was real structural system. VE33, pure bifurcation incentives. And then Tapioca is at another level with options emissions. Protocol and liquidity has Frax overtones with the stability they've achieved with Frax, FRAX, the actual stablecoin. They have totalitarian dominance over the peg, and that's what Tapioca should be able to have as well. And I think the options emissions really changed the game there. I think just everything Tapioca's building changes the entire game. Let's got to watch it build its liveliness, and that if it does what it's written on the box, it's gonna set the bar much higher for a lot of protocols, if not just dominate the space with what it's capable of. It does everything. Seamless cross-chain, money market, credit market, X, Y, and Z all day long, protocol and liquidity, Frax's innovation. It's quite impressive to say the least. Do you use any methodology for factoring in smart contract hack risk with protocols like TAP, V33s, etc? You must, and you mitigate that with position size. Size allows you to, that's risk reward. So if you excessively size and it works out okay, you get big reward. If you size and it doesn't work out well, you get a big loss in there. So position size is very meaningful. Historically, I would say 1% to 10% changes everything. Still true to this day. 1% of the portfolio blows up and becomes nothing, doesn't really do much. But if it becomes 10% of your portfolio, kind of changes the entire portfolio. So that's something to consider with regard to position size. We only could tell our stories from hindsight. What does that mean? In 4 years' time, you'll be able to tell how well your portfolio did. And please do not put it on you. It's not what your choices. Yes, obviously it's your choices that result in bad or good outcomes, but it's not you. It's the market. The market does what the market does. The market will market. And all you could do is make the best decisions possible. So in 4 years' time, judge your performance based on how well you stuck to your rules, not how well the market did. Because the market you're not in control of the market. I think that's a very important point. And last one, V Cleave gives governance power to Curve. V Cleave Cleaver dominates convex. Crazy. Not gauge voting, but proposals. Will you consider investing in order to have that power in the DAO? I actually was thinking of a little bit of exposure to Cleaver, because a little bit of exposure to Cleaver gives you a hell of a lot of convex voting power. I think that's interesting. But I don't know. I don't know what kind of position size, because it's not necessarily an X, Y, and Z, because it's not like you're getting vote rentals, pure vote rentals. Cause getting 100 to 1 vote rentals on Cleaver, that would be crazy from a Vodium perspective. So that isn't the case. So is what it is. It is on my mind though. I have noticed the amount of VLCVX that VE Cleve controls, and that's it. Appreciate everything, Cap. No second best. Have a good day, y'all. Have a good one, my friend. I appreciate you as well. First glance over the thumbnail, I thought you were a rabbi. Pretty funny. No, there's a pirate. I am a captain. Arg. Can only be one Captain Rational, I guess. All right, my friends, ladies and gentlemen of the crypto space, 354 people made it to the end of the stream today. I appreciate each and every one of you. Tell everyone to subscribe because together we could do a little bit better and we could be a little bit more rational in these absolutely insane crypto markets. Till next week. Till later this week. I'll see you again on Wednesday. Peace.